Happy VA Wednesday. Today we're going to talk about VA 5-year adjustable rate loans. It's not something I've covered recently because it wasn't really anything the industry was pushing until recently, but I've seen a lot of loan officers pushing the 5-year ARMs on veterans. So I wanted to make sure that you guys knew pros and cons and what to watch out for. If you're new to the channel, my team is one of the top VA teams in America. Call us, 786-933-2077. We're always happy to look at what someone's telling you or offering you and being like, yeah, that's good, or that's terrible, because we see both of them. And you never want to end up in a position where you're paying more than you should to get a mortgage. Okay. 30-year fixed rate. It is the most conservative vanilla product in America. I'll be honest, guys, my mortgages are 30-year fixed mortgages. I have never done anything but a 30-year mortgage, and it's because of what I witnessed after 2008. A 5-year ARM is fixed for 5 years. The VA ARM, I would argue, is one of the least predatory ARMs out there. I think it's actually a good ARM. You know, if it fits your parameters, if you're not in any of the risk buckets that I'm going to talk about in a few minutes, I think it could be a good product if you are getting a significantly lower rate than a 30-year. That's the thing. Right now, I'm seeing so many loan officers pushing the ARM, and I'm looking at the rates they're quoting. I'm like, I can do that on a 30-year. You know, the lender doesn't have very good 30-year interest rates, so they're pushing the ARM because ARMs traditionally are lower than 30-year fixed mortgages. With the 5-year ARM, the rate can go up. If rates, let's just do worst case scenario, because that's the way you should look at these products. Always do worst case scenario. So let's say you're in the house for 5 years, rates go up 1%. It can go up 1% yearly until a cap of 5% above your start rate. You're like, So if you start at 5.5, you can go up to 10.5. That's the max. That's the highest the loan can go, okay? This doesn't change. It doesn't change. And look, a lot of people go, oh, well, you can just do a VA IRRRL. Like, you don't even need to worry about it. Like, conventional loans, like, you could have more issues, but you don't need an appraisal with a VA IRRRL. You don't need this. You don't need that. So you're safe. Except. So let's talk about that real quick. So VA IRRRL, if you're unfamiliar, that's the VA interest rate reduction loan. It's a VA refinance. It's the most popular, you know, no appraisal, no income docs. It's a slam dunk close. Except, let's say that you buy a house and you buy the house with your wife or your husband and you guys love the house. Oh, 2 years later, you're divorced. That's right. But you guys qualified for the house together. Maybe you got the house in the divorce and you got this 5-year ARM and the rate's gone up and you're like, oh my gosh, I can't afford this. And guess what? You can't do a VA IRRRL. That's what people don't realize. So if you have, for instance, that the original loan, 2 people were on that loan to qualify for that loan, I can only do a VA interest rate reduction loan if the same people are on it. Otherwise, I have to requal and make sure you qualify. That is the risk with the ARM. Okay, look, if it was a conventional loan, there's a lot of other risks, but with VA, that is the biggest risk with the loan. The biggest risk with the loan is if you're buying a house with someone else, that's how you qualify, you split up, the rate goes up, you need to refi, you want to do that VA IRRRL, and you can't, and you don't qualify on your own. That's the risk, okay? With the 30-year mortgage, if you guys qualify together, you guys split up, as long as you're making the payment, who cares? It's fine. Okay, this can lead you into the world of having to requalify. And if you don't qualify, guess what? You're going to stay in that ARM. Okay. Also, if rates go up over time, you know, you could end up with a higher interest rate than if you did a 30-year. Now, I know the current trajectory, everyone's like, rates are going to go down, rates are going to go down. I don't know, guys. I mean, here's the thing. The Fed has a dual mandate, and the Fed does not control mortgage rates, but it's a good version of the economy. Inflation versus jobs. Well, if inflation starts ticking up, we're not going to see rates go down. It's that simple. But if inflation gets in line, we will see rates go down. Fun story. 2022, I refinanced one of my properties, and I got 2.625 on a 30-year fixed rate. I was delighted. I was over the moon. I'm not a veteran. That was a really, really good rate. And at the time, I went out to dinner with some of my friends who are also loan officers, and they're very good loan officers. They just have a very different mindset than I do. I'm super conservative. I'm always going to look at the risk because I don't like risk. And I'm like, yeah, I just got 2.625, 30-year fixed. And they go, oh my gosh, why did you do that? I'm like, because it's a great rate. You could have done a 3-year ARM at 1.2%. And I'm like, yeah, I don't like ARMs. Not doing it. Okay, guys, think about where we are now. If I had done that ARM at 1.2%, I would already be adjusting upwards. That beautiful 2.625 that I got on that 30-year fixed rate, that's never coming back. Right? The ARM would have costed me so much more money over time. It's crazy. And that's what I want you guys to think about is like, look, if you're looking at 2 loans, and I would argue, let's say the 30 years at 5.75, no lender fee, no points, the ARM's at 5.625, no lender fee, no points, I would always pick this one, personally, because of the ways I've seen this stuff go sideways. Now, if the 30-year was at 5.75 and the ARM's at 5% and you're qualifying for the house on your own, okay, let's do the math. That's interesting, right? But the key is going to be, does the benefit, is it worth the risk? That's always what you need to look at when you're looking at these loans is the benefit worth the risk? And if it's a huge rate difference, yes. But if it's not, probably not. So questions, comments, if you want to look at what we're seeing, give us a call, 786-933-2077. Also, just a heads up, a lot of lenders are missing this guideline right now on VA refinances. So if you have a conventional loan right now, in order to flip into an ARM with a VA IRRRL, the rate has to be 2% lower. So just a heads up on that, because I've already heard, oh, the loan officer said they'd close my deal. And I look at it, I'm like, yeah, they just don't know their guidelines. So watch out for that, guys. I hope this was helpful. Thanks for watching.